From 2018 to 2020, the United States and China engaged in a trade dispute. Headlines focused on tariffs, decoupling, and economic competition. While policymakers discussed barriers, financial institutions continued to seek connections. Major U.S. financial firms such as BlackRock, J.P. Morgan, and Goldman Sachs maintained and expanded their presence in China. This situation highlighted a contrast. Public policy emphasized separation, while private capital pursued engagement. To understand this, it is useful to look beyond headlines. Capital generally seeks growth and returns, rather than political objectives. Politicians often focus on election cycles, whereas investors tend to consider longer-term horizons. During this period, U.S. financial institutions directed approximately $1.4 trillion into China. This was a deliberate investment decision. These firms were not acting against American interests. They were making decisions based on China's economic prospects. The movement of capital can often provide insights into future trends, sometimes more so than official statements. Ultimately, capital tends to follow opportunity, regardless of political considerations. The trade dispute was not only about tariffs, it also involved significant financial strategies by global institutions. Even as political discussions continued, the structure of global finance was already evolving. While the world focused on tariffs, China was opening its financial markets to foreign giants. Beijing raised ownership limits, allowing Wall Street firms full control for the first time. The response was immediate. BlackRock, J.P. Morgan, and Goldman Sachs expanded rapidly, launching new funds and acquiring local ventures. China's market was vast and undertapped, with a growing middle class and a hunger for investment products. For Wall Street, the potential dwarfed what was left in saturated Western markets. The numbers told the story: over $1.4 trillion in new and planned investments, even as trade tensions raged. In the West, ultra-low interest rates squeezed returns. China offered higher yields and growth. For global asset managers, investing in China wasn't just attractive, it was a fiduciary duty. The real action wasn't in the headlines, but in the flow of capital eastward. Wall Street's pivot was strategic, long-term, and impossible to ignore. The flow of capital from an old power to a rising one is a recurring cycle in financial history. It unfolds in 4 stages. First, a strong central bank and stable currency attract global capital. Second, the dominant power expands its debt, financing ambitions by issuing bonds the world eagerly buys. Third, overextension. Debt piles up, growth slows, and confidence cracks. Fourth, capital flight. Investors quietly move assets to a rising power with better prospects. This cycle is played out for centuries, shifting the world's financial center from one empire to the next. The movement is gradual, but once it starts, it's hard to stop. Smart capital always seeks the next safe haven. The story of global finance is the story of these 4 stages, repeating again and again. Britain's financial empire is the textbook example of this cycle. In the 19th century, the pound sterling and London's markets ruled the world, but 2 world wars forced Britain into massive debt, eroding its financial foundation. Post-war, Britain struggled with sluggish growth and mounting obligations. The Suez Crisis exposed its vulnerability. America called the shots and the pound's dominance was finished. Capital began its slow exodus from London to New York. By the late 1960s, the dollar had replaced sterling as the world's reserve currency. The shift wasn't sudden, but relentless. Britain's overextension and debt made way for a new financial order. The world's financial center had crossed the Atlantic following the cycle's logic. Empires fall not with a bang, but with a steady outflow of capital. Imperial Germany's rise was a cycle interrupted by war. By the early 20th century, Germany was an industrial powerhouse, attracting capital and challenging Britain. It built a strong central bank and a robust currency, moving through the early stages of the cycle. But geopolitical tensions exploded into World War I, halting Germany's ascent. The war's cost and post-war reparations devastated its economy and currency. Sometimes, the financial cycle is violently cut short by war, not completed by market forces. Germany had the ingredients for financial leadership, but conflict destroyed its chance. The lesson: geopolitics can override even the strongest economic trends. After World War II, the US took Britain's place, launching its own financial cycle. The Bretton Woods system crowned the dollar as the world's reserve currency, backed by gold and America's industrial might. The US funded wars and social programs by issuing debt, exporting dollars worldwide. The exorbitant privilege let America borrow cheaply and consume beyond its means. In 1971, the gold link broke, but the dollar's dominance continued. Now, as the petrodollar, US debt soared, financing tax cuts, wars, and bailouts. By the 2010s, America was the world's largest debtor, not creditor. The dollar's foundation shifted from gold to the global appetite for US government debt. The system's stability now depends on the world's willingness to keep buying US assets. America's financial power, once built on surplus, now rests on debt. The cycle's third stage, overextension, was underway. The next move would be watched by the world's capital. By the Trump era, US overextension was clear: soaring debt, deindustrialization, and near-zero interest rates. Investors faced a dilemma: US bonds yielded little, and domestic growth was sluggish. The search for yield became the driving force in global finance. Wall Street's pivot to China wasn't political, it was pragmatic. China offered higher growth, better yields, and a more stable currency. For asset managers, diversifying into China was logical, not ideological. Even trade war tensions made Chinese assets more attractive as prices dipped. The real story was long-term capital moving from an overextended incumbent to a rising challenger. Wall Street was looking decades ahead, not just at the next election. The cycle was repeating, quietly but unmistakably. As the US overextended, China positioned itself as the next capital haven. It modernized its financial system, opened markets, and invited global investors. China's bond and stock markets were huge but under-owned by foreigners, an open door for growth. Chinese assets offered diversification and a different risk profile from the West. Unlike the US, China was a creditor nation, with lower debt and higher reserves. Its fiscal prudence and growth made it a magnet for global capital. The $1.4 trillion flow was a strategic reallocation, not a panic. Chinese policymakers timed their market opening to exploit US weaknesses. They used the West's own capital to accelerate their rise. The fourth stage of the cycle, capital exit, was playing out in real time. The world's financial center was beginning to shift, quietly but decisively. China's strategy was deliberate, and Wall Street's response was rational. The global order was being rewritten, one investment at a time. As of late 2025, the capital shift hasn't reversed, it's accelerated. The US remains deeply indebted, China keeps opening its markets and internationalizing its currency. Wall Street's actions reflect these realities. They're not causing the shift, but channeling it. The dollar's dominance isn't ending overnight. America still has deep markets and global trust. But transitions between financial hegemons are slow, often taking decades. The $1.4 trillion flow marks the start of a new phase. Investors hedging for a post-American world. This is the logic of capital: cold, rational, and relentless. The US isn't being abandoned, but the era of unchallenged dominance is fading. The world is moving toward a multipolar financial system, with China as a new pole. History is a map, not a prophecy. Wars or shocks can disrupt the cycle, but the deep currents, debt, yield, and economic momentum, are hard to resist. Wall Street's pivot was a signal. The financial center of gravity is shifting. The consequences will shape the world for generations.